Okay, outside the firm, I've got a couple of examples. I'll probably just have time to talk about two of them. Okay, I want to talk a little bit about investment decisions, so connecting to complexity theory perspectives on financial markets. We know there are some papers out on that, so I want to give you an example of a case study on that. And second, I'll talk a little bit about this idea of sustainability. Okay, so sustainability is a major issue for government. So in the healthcare sector, for example, we know that demographics are one of the big drivers of what actually happens to hospital services, but it's not quite clear how that connects to the accountability either of the politician or of the organisation to society. So I did some work with a medical professor at Imperial and a colleague in the London School of Tropical Health to look at this, and basically it's a question of costing. So governments have to pay for services, but there's a lot of pressure on governments, they're running out of money or whatever, so they tend to want to underfund things or put it off to the next generation. So what we did was we tried to redefine the risk as being not at a point in time, but it being a risk about over time. So what's the problem? The problem is that healthcare is very expensive. It's getting more and more expensive, and we somehow need to still sustain the service despite the fact that it's more costly. So politically, what's the situation? Well, what we do is we define sustainability as being a question about having enough money, enough money to maintain a service at the current level of intensity and quality for both people now and in the future. Why now and in the future? Because the funding model depends on throughput, depends on who's using it, what they're doing, who's consuming it, where that's going. And we find that if you think about financial sustainability, it actually gives you a different answer in accounting as to where the risks are. The risks are that you get a lot of older people as they get older expecting a high level of service, not enough people around to fund that continuing level of service. And then the second one, I think I'll stop after this one because I'm a bit concerned not to go through more time. Here's the second one. The second one's about investment decision making. And basically the idea here is that standard theory suggests that managers chase alpha. What's alpha? It doesn't mean they become a monkey or something. It just means that alpha is the excess return of a stock relative to the market. So you regress a series of data on the stock market return, then you regress that against the return on the specific investment, and then you take the intercept, and if it's positive, then it's great. If it's negative, you're a bad manager, go away. Okay. So there's a lot of assumptions about that. So what we did was we tried to get away from that standard financial theory, which is driving London in terms of how you manage a hedge fund or how you evaluate a manager who manages that hedge fund or pension fund. We try to work down and get a bit of detail. So the manager voluntarily gave out to us lots of grounded data, and that allowed us to explore something a bit more. So we discovered that, again, going back to the target, there are four options. One option is, you buy the stock and that stock is a success, that's great. Or you're smart enough not to buy the stock and the stock is a bad stock, and that's good. But you can also have things in between, a false negative or a false positive, right? So have to watch out for that. Second, you have to think about sentiment, the sentiment of the decision maker, going back to risk appetite. So does the manager own the stock in his portfolio or her portfolio or not? And again, depending on whether they own it or not, is a reflection of their sentiment towards that stock. You can be overweight in a stock or underweight relative to the index. Remember, that's the Y, you're the X. So that will lead to a sentiment effect. Okay, so the initial take that most people think about investment is to say, okay, skill is either due to the track record or it's due to some good luck. Okay, so very hard to determine whether the style or the sentiment or the track record is driving the result. So this is not an approach that's very useful for complexity theory. Now, what we're going to do is going to break it down and say, okay, We've got to work out how many of these stocks we own and how much we don't own. That gives us an idea of sentiment. How much of the stocks are we trading, buying and selling? How much are we holding? Okay. Holding a stock is different from trading a stock, different kind of behaviour. Get a little bit more detail. So now we take the third cut. Now we're thinking about the hit. You know, did I get the decision right or wrong, positive or negative? Second, the win to loss ratio. In other words, how much money did I put on the bet? You know, you can take a bet for a couple of pennies, or you can take a big bet for millions of pounds, right? So you need to know both things. You need to know how much is right and wrong, but you also need to identify the quantity of the bet. Doing that, we can discover a lot more about behaviour of the manager and discriminate behaviour. I won't go into the detail for time. But essentially what we found is we found evidence that confirmed behavioural biases. One behavioural bias is called disposition. Disposition says that you love the things you buy, you want to hold on to them, and when you sell, it's a different story. You don't want to get rid of them, or if you get rid of them, you panic. It's like a rat, right? Cognitive science rat who sells is panicking. When you buy, it's very rational, okay? And we find evidence of that going on. Okay, I've got lots more examples, but I don't want to take any more time. How much time have I got? About 5 minutes or so? 5. Okay, I want to have a bit of time for questions, so what I'll do is I'll skip through all this gump here, and I'll just say, right, in terms of where we're going, I think, you know, putting together this complexity approach at the level of the corporation involves, I think, having a communication, having a discussion with the FSA about how do they go about showing to investors what are the investments available. Is there a better way to do it than the kind of current league table? Is there some way of incorporating some sense of risk appetite or risk tolerance into the website so that an investor can better discriminate different investments available? You've also got investment associations. I mean, I was very much talking to the UK Shareholders Association about how they communicate to their shareholder membership information about risk and return. And thirdly, there's also questions about the institutional environment. So if we can have a discussion that talks about risk appetite and risk tolerance that allows us to think about the issues rather than put them to one side, things like financial sustainability may become more important.
So where do you actually see, Paul, the FSA sitting in this? You know, because they are a factor in the decision making going forward on risk appetite, because they keep sort of saying that this is required. How do you see that playing out?
I think the FSA is caught in a bind because its terms of reference as an organisation are both to promote market efficiency but also to provide information to consumers. So the problem you've got is that there's always a political dialogue as to how much do you reveal to the investors about a product. Before the FSA existed, there was a previous organisation called the Personal Investment Authority, PIA, and all these others, and they had a league table where they said, okay, if for a given £5,000 investment, how much commission would you have to pay on a policy that would last, say, 20 years and was endowment or was, you know, a personal pension? And they actually got the providers to give quotes as to the value and the impact of the commission, whether it's an upfront commission or ongoing commission, so that the investor could work out what the final value of the investment was. Okay? And it's only if you know that at the level of the actual investment that you're really able to work out to discriminate between the different investments. Yeah? If you don't do that and you expect the investor to create their own model, it's a recipe for disaster. And so I think part of the problem here is that, you know, we don't have the information, we don't have the level of information that's useful at the decision-making level.
Almost a secondary question really is, it's really interesting you're talking about this behavioural aspect as an accountant, and you know, this is very much where the system centre is sitting between combining hard and soft systems.
Yeah.
So hard engineering and sort of soft systems, which is the behavioural side of it, I guess.
Yeah.
I'm intrigued with that. I mean, where do you see that going? How much, you see it a bit in publications, but
Yeah.
how much in reality is happening around that interface, the combining of those two?
Not a lot. I did a study over about 15 years where I tried to work out asking investors to look at a prospectus and say, well, if you were to buy a debenture or a pension, and I gave you this prospectus, which was really, really short, had no financial information in it at all, then I gave you another one, which was legally approved by a registry body, had 100 pages, and only showed the things you needed at the back. Turned out that what's called information overload, or data load, which is the amount of non-concrete information, is quite important to the investor. But it's only important if you assume the investor is what we called a novice investor. We are talking about retail investors, not institutions. If you're a novice, you just read from the front, go to the back. But if you're an expert, like an actuary, hopefully, they'll know where to go, right? So the impact of information load, data load, this idea of a disposition effect, is also conditioned by the environment, as well as the personal characteristics, if you like, or the expertise or sentiment of the individual. So I think you can only have a conversation about that, recognising that, first of all, accounting is a public good. Yeah, it's not a private good. Second, that the biases that happen are things where regulators can have a role to ameliorate, but only if they're not facing these political impediments to stop them giving clear guidance to help an investor, as opposed to a cynical financial advisor who, after all, is only there to confuse you. After all, how else would they make money?